Welcome to The Landscape, George Smith Partners podcast. Hello and welcome to The Landscape. This is George Smith Partners podcast. Today, I'm joined by a special co-host, Mr. Ed Steffelin. Ed and I are co-founders of Access Capital, the parent company to George Smith. Glad to have Ed here joining us on the road today. He's currently in Florida, but Ed works out of our New York office. And I'm going to let Ed introduce our special guest today. So Ed, I'm turning it over to you.
Great. Thanks, Evan. It is my pleasure, as always, to introduce Tim Sullivan, Chief Advisory Officer at Zonda. Tim and I have been colleagues and friends for way too long. And so, Tim, really appreciate you taking the time. Tim is an expert in all things housing and knows every single person in this universe. And so I can't wait to dig into some questions here. So welcome, Tim, and thank you. All right.
Thank you, Evan. Thank you, Ed. I'm here for you guys. Let's fire away. I'm ready for you.
Well,
Let's go.
yeah, why don't we
Tim,
start?
do you know anything about housing?
Oh,
Just kidding.
A little bit. Just a little. Eddie, you go first.
yeah. Well, why don't you, I don't know, do you want to give us just a quick background on yourself and Zonda, just as quick so everybody knows what you do in Zonda? It's a great product, and so I think you should give us a little background.
You bet I'll end up with Zonda, but my trajectory through a 4-decade career has been around housing, market research, ultimately trying to create an understanding of what to build, where to build it, how to finance it. And I've been at KPMG. It was with a small consulting firm named after me some years ago, and also at Myers Research, which leads us to Zonda. Myers Research was a company that was nationwide, tracking all of the actively selling subdivisions. And about 8 or 10 years ago, we merged with Metro Study. And with Metro Study, that was part of Hanley Wood, we formed the only database that tracks for sale and rental and lots across the country. I oversee our advisory team. We've got our data side and a massive amount of technologists there. And also we've got a media side, Builder Magazine, Multifamily Executive, and all of our conferences. And as some of you may know, Evan and Ed have spoken at a number of our events. So it's always a pleasure to get back together with you guys.
Yeah, they are great events. And because it is graduation time for a lot of college students, and because you've made it through 4 decades, do you have any advice for those young folks out there looking for jobs in real estate?
Absolutely. Talk to the people at George Smith Partners
That's
because
right.
they're hiring really smart, but you got to know the capital markets. Even if you're coming fresh out of school, if you've got a really good research mind, talk to me. But honestly and straightforwardly, put yourself out there and talk to people, network and talk to people that you know that might be in the industry and crisscross those connections. Connections count, but ultimately it's up to you to show that you're the person we want.
Yeah, good advice.
That's great.
All right. And then I think there's probably a little bit of consternation out there. And, we've seen some kind of rough housing numbers from the big publics. Do you want to just maybe start high level on the for sale market and kind of what you guys are seeing and
You bet.
your thoughts on that?
Well, I could make a heck of a case for housing demand and unmet demand. We can get to that in a second. So, underlying elements of housing are there. And what I mean by that is life happens. We've got people aging, we've got divorces happening, kids are being born. There's all these factors that generate demand for housing, along with affordability or lack thereof. Another thing we can talk about in a minute. But right now, housing's hurting, the for sale side particularly. And it has to do with a couple of things. Number one, affordability. It's just terrible right now. Interest rates have gone up, prices have gone up, but there's also the big U that's out there in uncertainty. And that pulls the consumer back. And whether somebody's going to buy a house or a car, and of course a house is the biggest event they're ever going to spend money on, it's putting the pause button for most people. And that ultimately makes things a little bit more difficult for our industry because when people aren't confident, they're not going to buy homes. When homes aren't being purchased, then we get a clogged system. And we're starting to see that a little bit right now.
All right. Well, it's interesting because I also think you're going to now weigh into the publics versus privates, right? Large public home builders have, a bit of financing advantage, a bit of sourcing, a bit of cost advantage. So how do you see this playing out? Do you see more merger activity? Like, what is your take on that?
I think it plays out much as we've seen the last 2 years. We can push forward. I think the concept of consolidation will consider or will continue. And you mentioned the reasons why the publics have an advantage. I mean, they've got a capital markets advantage, cheaper access to capital and more direct access to capital. Plus, there's a scale element that right now makes such a difference when we're looking at tariffs and the cost of inputs. And when you are putting out 20,000 homes a year versus 1,000 homes a year, the way that you can deal with your subs, with the trades, and ultimately purchasing product is much different and advantageous. Now, I don't believe that we'll completely lose the private builder market because there are some big privates that hold up really well. I mean, Shea Homes is a great example. Ashton Woods, another example. Fantastic home builders, but they operate more like the publics. They've got that access to capital and they're in multiple markets. But there are a wide variety of smaller builders. I mean, builders that are doing 400 to 2,000 or 3,000 homes a year, and they have a great angle in their market. They're well known, good reputation, build good product. They'll hold on. But I do think that there's a magnetism right now for the publics to continue looking at some of those bigger privates. And a great example is what Lennar did with Roush. I mean, they came in and ultimately took down an organization that had thousands of lots, and they went to a market. Lennar went to a market that they were just not prominent, and now they've overtaken that market. It makes total sense. And when you talk to a public builder, they're going to be driven by a couple things. Certainly, market share matters, gross margin matters, but ultimately, the power of a market when they can control it, that's another one of those factors that gives them an advantage. And I think we're going to continue to see consolidation as a result of that.
Okay. And then,
Interesting.
Evan, maybe we should ask the big T question, tariffs. What are we thinking on the tariff side? What are you hearing from people on the home building
You
and
bet. Well, I think first and foremost, it's whiplash. I mean, they're on again, they're off again, they're 150%. Oh, we're not going to do it with China. Oh, we are going to do it with China. Mexico's off. No, Canada will be together. It's hard to define right now, but I can tell you that we have an entire building products group run by Todd Tomilak here at Zonda. Todd and his team are amazing, and they've been digging into the implications. And the implications right now are what if? What happens if this kicks in, this kicks in? And they've looked at component by component and come up with an estimate that around, you could probably estimate a 9% cost increase to the price of a home based on the tariffs that we're aware of. Now, keep in mind, some are more egregious than others. If you have access to lumber through the United States or even a pre-existing relationship with Canada, your cost is going to be compressed.
right?
But if you don't have a forward-looking situation with your windows and that aluminum's coming from China and China's basically saying, good luck, that is more egregious and more of a problem. So again, all those levers are being pulled right now, but we're estimating for what we know right now that at least a 9% increase in the cost of building a home.
Wow, it's a lot. All right, and then
Uncertainty.
I think one of the things that we do a lot of as well is rental housing, which includes obviously multi and build to rent. And I know you guys obviously have a new build to rent product as well, which is relatively you know, expansive relative to everybody else tracking every build to rent community in the United States. Do you want to talk a little bit about where you see rental housing at this point between multi and build to rent and maybe the differences in that sector
And similarities,
and
because
similarities?
you guys know better than anybody. You're involved in the capital markets. You play in the multifamily and the build to rent side. And the last 2 years has not been an easy time to place
Yeah.
capital to do anything multifamily, do anything build to rent. You guys know that the best. But there's some interesting dynamics that are happening here, and I'll separate the two. Let's first talk about multifamily, because multifamily got hit harder than build to rent, at least initially, because we were basically overbuilt for a period of time, and we're burning through that right now. And the capital markets then pulled back. Now, the thing with the multifamily side of the world is that really look at who your consumer is, and you're primarily 1 and 2 bedroom units. There's some three, but those are singles and couples or, commingling. When we get to the build to rent side, and you start looking at, product that you've been involved with, Ed, whether it's townhomes or single family, we're typically looking at 2, but definitely 3 and sometimes 4 bedrooms. So you've got a different renter profile. And that's also going to inform where we look at markets for each of these, because there are drivers for each of those. There's an overlap of multifamily and built to rent, but they're not the same thing by any means. The product's not the same, the size of the units aren't the same, and most importantly, the consumer's not the same. And that's what I want to go to, because when we overlay what's happening with the for sale side of the world right now and how expensive it is, I think that informs the rental side very, very positively over the next 2 years, because we're starting to build through any over supply from the multifamily side. We've got affordability that is just crappy. And then you've got people that need places to live, whether they're moving and go back to that life happens thing, got a new job or got married. And that's why specifically on the build for rent side, townhome or single family, I feel like the runway is outstanding. Now, right now it's bumpy because of the capital markets and what happened with maybe some of the markets being slightly overbuilt. But the build for rent side, particularly townhome and single family, I think that is the missing middle. I mean, quite frankly, guys, I think that, I've got 3 kids that are in their 20s, almost a couple almost in their 30s, and I don't see them buying a home anytime soon. And I think they'll be able to live a single family lifestyle without having to qualify for the mortgage, get a down payment, and maintain the damn house. So I think there's some pretty cool, uh, let's call it current, but also future looking opportunities. And Ed, let me kick that back to you, because the fact that you're active in Florida and Texas, and share with us what you're seeing and hearing on the ground from both consumers and from the trades.
Yeah, so I think what we've seen is cost increases haven't been that bad yet. I think a lot of people are still processing what it actually is going to be. Like you said, there's a big amount of confusion out there. I think that uncertainty is hitting people. I would say the other thing we have seen a decent amount is bad debt, which people haven't really been talking about, right? Some fraudulent applications, bad debt. And while I love AI, I think they're also using it to, people are smart to use that to fake bank statements and fake pay stubs. And so I think we are seeing that. On the demand side, I think we've seen a lot of concessions come off. As you said, with that oversupply, we saw a lot of concessions. And I think a lot of markets that's starting to pull back, thank goodness. And so I feel like the demand side, and I think, well, somebody put out the demand is actually, they're absorbing. They may not be what the rents people wanted, and there may be concessions, but units are absorbing, which I see as a big sign of strength here. So I think that's been good. And I know you guys independently track, I think historically there's a lot of multifamily data out there. And I know you guys track purpose-built build to rent communities, everyone across the country. So how does that look from a supply perspective? I mean, we talk about rental housing supply in the aggregate, but when you break it up, is it, what is your sense of the actual purpose-built build to rent communities relative to multi?
Well, take a step back first, because you said an important thing about absorption. Things are leasing up. And on the for sale side, the sister to that is being able to sell a home. And I met with a board of directors of a public builder last week, and the question came out of, how do we get through this? And my response was, we sell through it. And the follow-up question was, what does that mean? I said, we do whatever we can to sell through, and same thing on the rental side, to lease up. We find somebody that needs a place, we have to work with them. It may be more than
Yep.
a 1 month on a 12-month lease for the build for rent side, but so be it. We're going to get people in, and then we can look at retention. So that is happening. And to me, that is the lifeblood of coming through the other side for both for sale and rental. Now, when we look at the build for rent side, the important thing is that we look at active, and we also looked at proposed communities. So, at one point we had something like 120,000 units in the pipeline
Wow.
that are supposedly going to come to market, but they weren't all financed. And that is the single most important thing, is what got financed, what will get financed. Because
They
when you
must
look
not have
at,
hired George Smith Partners.
There we go.
Exactly.
There we go. Well, either that or Eddie, they were in markets where, there just wasn't, there was enough product already. And smart capital guys like you came in and said,
Right.
you know what? You better cool your jets for a year or two. So that's a very positive thing that I'm looking at too. And I think right now we're tracking something like 2,700 active communities on the rental
Wow.
side. And they're moving. We haven't seen any deals, then this is going to come back to you guys because I want to hear your take on it. We haven't seen any deals where, somebody's walked away and said this is the worst thing in the world, but we are seeing, deals that are at C of O that are trading at maybe below replacement cost,
Yeah.
not far, but below replacement cost. And there's been some transaction there. Are you guys seeing that, or when you think about anything that could smack of distress, what do you guys see? Evan, let's start with you.
Oh yeah, no, I mean, just to be clear on the George Smith side, we have the a great purview into hundreds of different clients in different markets. And certainly in multifamily, probably more so than built to rent, we have seen some projects that were built, well above where replacement cost would be, or they're trading above where replacement cost would be, and they're relatively new. On the built to rent side, I think that, anytime you have a sort of a rush to a new asset class or something that's new and exciting, you bring in a lot of new entrants, and some of those entrants may have great experience in other areas, and some of those new entrants may not have any experience, and they're just kind of rushing towards what they perceive as a gold mine. And so I think the shakeout here could be a little bit more shaky on the built to rent side than potentially on the multifamily side, where I think maybe a few more of those folks were seasoned in cycles in that product and asset class.
Yeah.
So I also think that there's it's highly market dependent. There are certain markets that, for built to rent in particular, uh, were perceived to work better, i.e., land was cheaper, more accessible. I'd be shocked if in California, for example, there's a bunch of built to rent projects that are really struggling. There may be some, but certainly in certain markets where land was a little bit more accessible, sort of barriers to entry on the regulation side were lower. Uh, Certainly, there's a lot of built to rent projects that were overbuilt
Yeah.
and having to absorb. Now, supply is completely cut off, basically, right? New supply. I think that's the point you're making, Tim. Um, and because the capital market is sort of, while demand long term is probably real strong, the capital markets don't deal well with uncertainty. And so while we swallow the tariff question that Ed asked early on, I think there's just going to be a little bit more headwind in terms of getting something done. Now, over the long term, what those do, I think that's anyone's guess and where those things go. But certainly it's difficult to kind of run a projection that, gets capital comfortable. No one wants to get fired, right, for doing a deal that at the wrong time, so to speak. So I'll flip it back over to Ed though and see if he has anything to add.
Well, I think what we've seen too is we have seen people sell below replacement cost. We've also seen some people who are going to do build to rent just flip the land or lots to for sale builders because it's been so hot. And so we've definitely seen that. And I think the purchase below replacement cost is probably coming to an end here. I think that was a very popular move, and I think that has been it's been hard to develop new units for, to go to an equity provider and say, hey, look, let's develop something and take all the risks that go with development. When they're like, hey, I can go buy that today at a lower basis, already built and maybe partially leased, was a tough discussion. So I think part of that, as that shifts, we're going to see more and more new construction, and it looks probably like a pretty good time, right? In terms of, supply, you hit 26, 27, you're, leasing up a new project is probably a pretty good timing at that point in time.
So
Yep.
in other words, housing costs are going up. And I think, um, the big underlying question here and the macro thing in the United States and politically is like, how do you keep the cost of housing a little bit lower, more affordable
Yeah.
for Americans? And there's a lot of, social media driven ire pointed in certain directions, right? Depending on where you sit, you see all kinds of it. But maybe you can unpack that a little bit, in terms of the Wall Street ownership of uh, build to rent and what that might mean, and or maybe it doesn't mean anything, right? Because I think what we're
It's
all in,
overblown.
yeah,
It's overblown. And it's a media frenzy because there's got to be somebody that did something wrong that
that's right,
made housing so unaffordable. There is, and they're called municipalities.
exactly,
And they've done it through ridiculous entitlement processing, unreasonable fees, timeframes that are, and I've built homes, so I'm in a small way, I felt it and felt it in my pocketbook based on the time value of money, which I think you guys know a hell of a lot about. That is where the ire should be focused. The concept of institutional players buying homes, it's fantastic. I'll give you two reasons why. Number one, when and you guys know this, but the institutional players come in and they'll put 20 to 40 grand in each home for upgrades. And that alone upgrades a neighborhood. Secondarily, they're professionally managed. So, you don't have to call Jim Bob to come and, fix your plumbing because there's going to be a professional manager involved. If I'm renting, that's who I want to rent with. Furthermore, I got to add a third one. The number of homes that are owned by the REITs and the big players is a fraction of the housing stock. So it's overblown, Evan, and it's
oh yeah,
misleading.
I know. I just had to ask a question. Let me give you a follow-up question. I was at lunch with somebody today, and I don't know who invented this term, but California has a well-known sort of high cost of living, and depending on who you ask, again, it's either the greedy corporations or the really reality is that it's the impossibility of regulation. And this person said that basically you have these people in California called cave people, and they're citizens against virtually everything. And so when you get a lot of cave people pointed at your project, it may suffer, a little bit longer in entitlements. And I think and other regulatory hurdles. And I think you're actually opening up an interesting point when you talk about the time value of money. One of the huge, in my opinion, drivers of the cost of housing in California and across the country is just that. It's taking the risk on land, not knowing exactly what you get at the end of the day, what your density is going to look like, what your costs are, et cetera. You take an enormous amount of risk early on, um,
Well
in,
said.
in commercial real estate projects, and without real clarity,
Yeah.
and a little change here or there, a little tariff, a little, I don't know, whatever the next calamity is, and invariably it's works against you. So interesting, in the macro picture. What other like macro trends are you looking out for? I mean, in all the data, anything interesting that you're seeing that we haven't touched on?
You guys, we can relate what I'm about to say to any part of housing, but let's keep it on the rental side of the world because we've talked in the past, and I always ask this question, which markets do you like and why, and which will grow? So to answer that question, typically we'll look at a cross tabulation of a couple of things. And again, we're focused on the rental side of housing. And remember, we've got a little overlap with multifamily and build to rent, but it's
Yep.
the call it the rental part of the food group. Number one, cross tabulate where the job base is and how it's growing. Number two, look at age profiles because the demographic matters. You're typically going to see a younger profile in rentals, and then as they get older, they buy. It's not perfect, but it's another important thing to overlay. And then zero in on Gen Z and Gen Y because they are, although I'm going to argue as you start to get to the millennials, they're buying homes if they can. But that younger age group combined with where the universities are, there's a pretty close correlation there, and job base. And curveball, look at the higher incomes because as you move to the build for rent, Eddie, as you know, you're going to see higher incomes than you typically see for the Class A apartments. And those invariably will be some of the markets that have the long-term opportunity. And no surprise, Charlotte, Raleigh, Atlanta, Portland, because of the lack of supply. They've got a development ring you have to be within. So it's very hard to get approvals there. And DC, I bring this one up because DC fits all those cross tabulation elements. But right now with Doge and with the concern with tariffs and the uncertainty, we have to be very careful. But it does qualify initially for those cross tabulations I just mentioned.
Nice.
Interesting.
So if we put your investor hat on, a couple questions there. Do you own crypto?
I do not.
Okay, check. Second, if you had to pick a couple markets for rental housing, top ones, is there one or two of those you're like those that's where I'd put my money?
Yep. And I will give you the obvious, and then I'll give you some, maybe not right down the fairway, but close. So I just mentioned Charlotte and Raleigh. I'm a huge fan of rental for sale, B-backs, uh, any level of demography. We can look at the the two Carolinas as unbelievably opportune. I think long term it's fantastic. Atlanta has had a little bit more of this, but
Yeah.
because of its power and its connection to the Southeast, we have to pay attention. But I'm a huge fan, and part of it is I'm from there. Huge fan of the upper Midwest. And Columbus has really, come on pretty well. And
Yeah.
remember what I was saying about younger and universities and technology, they've got it. It's just a smaller market than some of the coastal markets. And then also pay attention to Indy and Cincinnati. Uh, by the way, a city that my family's from, but for 20 years we haven't talked a lot about, Chicago. I think to me, Chicago right now is one of the surprises.
Hmm.
So that's
This-
that's where I would start my focus.
The revenge of the flyover states?
Yes. Well, you know what? Think about what Evan was talking about with affordability and challenges of getting approvals. I'm not saying it's easy to approve in the
Right.
Midwest, but because the Midwest was ignored somewhat for the 80s and 90s, the smile states were the
Yeah.
only place to develop. There's people that their whole family's been there for generations. It's a great place to live, particularly if you're from there.
Yeah. Love it. All right. Do you know who's going to be the next pope?
Actually, I want you to know I've been doing a lot of research on it. So there are three popes or three cardinals that I think are the leading, but I've got a favorite after that. There's Cardinal Pietro Panoli. He's an Italian. He's a Vatican Secretary of State, and he's kind of the leading guy. There's Cardinal Peter Erdo. He's a Hungarian, and the third guy is Luis Antonio Tagle. He is a Filipino. But here's my vote. My vote is actually the cardinal that is based in Jerusalem, and his name is Cardinal, get ready for this,
Writing it down.
Pierre, Pierre Battista Pizzaballa. I swear to God, that's his
Oh,
name. That's
should
why I'm
win
voting
on
for him.
should win
Polly
on name
market.
alone.
Pierre
I'll put
Battista
that.
Pizzaballa.
I got that in my
So we'll put a bet
conclave
on Polly
bracket.
market.
Yeah.
There you go. Do it.
All right. The other thing,
All right. Yeah, go ahead.
I thought maybe we'd cover. Yeah, I know you since you live, breathe housing. I also know you like product type, you like innovation, you like master plan. All types of design. Do you see anything new, interesting, exciting that from a building product to a style to a certain type of master plan or anything like that out there?
For those of you who end up watching this, get onto our website, zondahome.com, and look up product because we have, I think it's something like 10,000 home designs that can be acquired or just looked at. And there's some really cool things that are happening with density, which we've talked about before. But the capability of what we're doing with density with just a 16, 18, 20, 2,200 square foot home is remarkable. The use of light and utility inside of a unit. But also really small spaces are getting a huge amount of attention. And ADUs, of course, have been heralded as the salvation for affordability. I'm not sure that's true, but LA has done, in fact, Evan's backyard, LA is doing a really good job with that. Southern California has embraced it. And the type of ADU is almost as varied as the type of housing. It can be a 10 by 12 unit that is really just a little office. It could be a 2.5 bedroom. I say a half because it's like a little, nook for study and 2 bedroom, 2 bath place. So there's really cool things happening there. On the bigger picture for master plans, I think the biggest splash, and pun intended, has been with Crystal Lagoons.
Yeah.
And the Crystal Lagoons are they bring premiums. They bring premiums to the land and the homes. We've done a lot of work with Crystal Lagoons, and we can actually prove that out. And it's an important factor because it's not just a physical experience, like you would get with walking your dog on a trail, but it's also a visual experience. And those two things are kind of like what golf courses used to be in the 1980s, where,
Yeah.
you had a golf course view and you got to play it. By the way, golf is coming back and COVID has had a big influence on that. But really the water element has been important. But let me pull back from that too, guys. There was a run up on the multifamily side, certainly, of an amenities arm race where we had
Yeah.
to have more. We had to have more. Here's the reality. The amenities we should have, whether it's rental or for sale, are the amenities that people will pay for and use. That is the litmus test for what we should include. Everything else is noise. So if you're in a place where people can't afford the extra $200 a month in the HOA for whatever that shiny amenity is, don't do it. The
Right.
key is align. Evan, it goes back to our conversation about affordability. Housing is a monthly payment business, and it's okay if we make something big and shiny. We just have to make sure people will pay for it.
That's right.
Yeah.
You've in the past asked about the next big thing,
Yep.
and whether it's product or whatever, here it is. It's simplification. And what I mean by that is people understanding what they're getting for their dollar and then people using what they're getting for the dollar. It's simplification.
Let's talk about construction techniques and, sort of the all the money that you see invested in either modular or 3D printed or some whiz bang new thing. Where is that all going to land? And what's the time frame?
Let's go from stick built, which everybody's familiar with, to the next element of modular. And we've done work with Fannie Mae, and we've worked with most of the big modular builders, as
Mhm.
we'd say, manufactured housing
Right.
builders. And their advantage is time because they still pay for sticks, bricks, cement, but being able to do things more quickly is how that can be a lower price product. Now, if you've seen, what Skyline does or what the guys that are part of the Oracle of Omaha's group, Clayton does, they are expert at creating this. But to me, it's still a segment of the market because most builders employ parts of that. They'll have trusses built off site, but they're still assembling on site. So if that is to come in, if manufactured housing is to really kick ass and create a sea change, we're going to have the facilities on a site because the time to travel from location to where we assemble it is where we often lose not just time but cost, the cost of ultimately transfer it. So there's plenty of elements still to conquer within the manufactured housing side. Now when you go to 3D printing, I freaking love it, and I love all the new technology that are trying to solve this thing, but nothing is scalable yet. And that's the biggest challenge. And when I ask home builders at our events, what do you think about modular housing, 3D housing, the new technologies? I would summarize their response to me in two words: not yet.
All right.
Great.
Not yet. What do you think about the privatization of Fannie Freddie?
Well, it sure looks like that's going to happen. So, there's a whole bunch of things to consider. Um, I think how it's implemented and communicated is so key. We've learned that from the Fed. If something's going to change, tell us how and then actually implement it that way. I think for investors, it could be a windfall because on the negative side, you think about, will it be riskier since it's not government supported and backed? And therefore, with private investors, do we have to charge a higher interest rate to give them better returns? What about, rate locks? Can we still get that?
Right.
So, to me, there's some answers that we don't have yet. I think we're headed that direction if you listen to what Bill Pulte says.
Yeah.
But ultimately, for those of you who haven't been in the industry more than 20 years, go back to before the GFC, and Fannie and Freddie were private, and then the world blew up, mortgages sucked, and the government
Right.
backstopped them and
Yeah.
basically took over to protect. So I think we're going back there, Eddie, and I'm worried because I don't think it's going to be easy, and I think it probably means it's more expensive. But I would
Yeah.
also like your guys' take. What do you guys think?
I think it's interesting. It's risky. It has to be done right because, look, Fannie Freddie securities are in the banking system. And they're, that guarantee is widely accepted as a AAA security. And so, I think it's balancing that risk-free aspect of those, which, translates to the borrower ultimately.
Right.
And there's just it's throughout our whole financial system. So I would just advise that hopefully we do it cautiously and adjust it accordingly.
And well
Evan?
capitalized, right? I
Yeah,
think that you have to be very well capitalized from the get-go.
Right on.
So that I think probably means that it's a long process, right?
yeah.
Okay.
So if you do it really quickly, you may not get enough capital interest to keep the because really like what you're looking for is an implicit guarantee at the sort of the entity level, right? And you can accomplish that as well by the capital structure.
Yep.
So
Okay, and maybe one
I'm
last
not an expert in
question.
that though. So
All right, maybe
What do you got, Eddie?
another
Go ahead.
question. I mean, our clients do a lot of studies. You do a lot of studies for our clients, right? Feasibility studies, market studies.
Mhm.
Are you cheating and using AI to make that quicker and faster?
Not yet. I will tell you that we are experimenting with AI for our data acquisition. And as you may or may not know, we also own rights to a satellite system. So we're able to track property and we're using machine learning to speed that up. Instead of having only people on the ground counting lots, we now have the satellites helping us with that. So
Are
that's
those
there.
checking us out right now? I mean, do I gotta?
They are. In fact, Ed,
don't,
you really should
don't let it
button
go
your
to your
shirt.
head, Ed. No one's
Button
looking
your
for
shirt.
you.
But AI, replacing what we're doing. I heard a great quote because I've been studying this for a couple of years now, and so has Zonda. Uh, don't be worried about AI replacing you. Be worried about somebody that uses AI replacing you, because AI can't do the creative for us. It can certainly assemble information, and they can put it together so quickly and help us get to a point. It can even help with your writing it. I mean, that you should really think about it. But ultimately, AI is going to be a tool that I think most of us will use. Just we're not embracing it on my side of the house yet.
Tim,
Okay,
why don't you tell us where we find you and
you
find
bet.
out more about your company?
Yeah, please reach out to me anytime at T Sullivan, Sullivan, at ZondaHome.com. I'm on LinkedIn too. Come to any of our events. We'll speak in person, but we're here to help. Anytime you've got a question, call me. Happy to just give you an idea about what you're trying to find out. And it's with great pleasure, Ed and Evan, that you've had me here. I appreciate it, guys, and we'll do it again soon.